Starting this month, there are some major changes happening with new mortgages. We've talked about it before. You could have to pay a fee depending on how expensive your house is that you're buying and how high your credit score is. It's a very complex plan. That's why we feel like we need to spend more time on it. Stuart Welch from the Welch Group joins us to help us with that. Good to see you this morning.
Good morning.
Yeah, we have done segments on this. And again, this is a plan. It's designed to try to help those who maybe couldn't afford as much a home not have to pay as much. But then on the other hand, it looks like people who have a high score are actually getting penalized for that.
Well,
Explain what's going on.
Well, I think they're taking some money from the people that have high scores and putting it on the folks that have low scores. This is an initiative from the Biden administration, and the goal is to expand housing to lower income, lower score individuals.
Increase home ownership. But how does it break down?
So I think the way to think about it is if you have a really high score, then what you're going to find out is your fees are likely to be more if you're getting a new mortgage. And so there's several things that I think you should do. The first one is you are going to want to hire or have a mortgage professional assist you. So don't try to do this on your own. A good tip would be a higher down payment may lower those fees. So it's going to be a mixture. It's kind of a formula. And you also, Mike, I think FHA is a very kind of specialized loan, but there's also a whole different kind of loan called a conventional loan. You might want to look at both and see which one makes the most sense for you. And I think you're also going to want to run some scenarios and you need to look at not just the upfront cost, but you need to look at the long-term cost. So it's going to, the way this formula comes out, it can affect the rate, and it also can affect the upfront fees. So it's really kind of a puzzle. Yeah. And you're going to need some help probably working through this to get the best deal.
And again, these are federal loans, and but some loans are backed by Fannie Mae and others. So, but the other thing you have to look at is if it's been recommended. For instance, if you're doing a conventional loan, instead of doing the normal 20% down, try to work it to where you can put 15% down. That is better to get PMI and then pay it off.
Yeah, so I think a higher down payment is probably going to get you a better rate long term, and it may lower the upfront fees. So you might want to save a little bit extra money to do that. And I think one thing I want to make clear is if you have a high score versus a low score, you're going to pay less, but the gap between the amount that's being paid from those low score to high scores is being squeezed. It's being tightened.
So it does still pay to have a good credit score because you are going to get a lower rate. But as you just mentioned, the gap is going to be closing a bit there.
Yeah, and I think the takeaway is this one you're going to need to study. Don't just go out and say, I'm going to put down 10%. You need to study this one before you make a decision.
And I would say shop around for those, right?
Definitely shop around.
Make sure you get the best situation possible. All right, Stuart Welch from the Welch Group, we do appreciate it. Thank you.
Thank you, Mike.
All right, still ahead now. How'd you like to own